All right, let's talk about something that gets a lot of buzz in the investing world. Options. They're seen as these incredibly powerful tools, but for a lot of people, they just seem way too complex. Well, today, we're going to cut through all that noise and get right down to the basics of how they really work.
So let me ask you a question. Picture this. You are absolutely convinced a stock is about to take off. But there's that little voice in the back of your head saying, what if I'm wrong? How can you jump on that potential upside while making sure your losses are totally limited if things go south? That's the exact problem that options were designed to solve. And the solution is built on this really elegant idea: having the right to do something without being forced to do it. The best analogy? Think about putting a non-refundable deposit on a house. You've paid a little bit of money for the option to buy that house at a set price. But if you change your mind, you can just walk away. The only thing you lose is your deposit. That right there is the heart and soul of an option.
Okay, so here's the official textbook definition. An option is a contract. It gives the person who buys it the right, but not the obligation, to either buy or sell something at a price they've already agreed on by a specific date. I'm going to say it again because it's that important. A right, not an obligation. That's the key to unlocking this whole thing.
Let's really hammer this home. Having a right gives you all the power. It gives you choice, flexibility. You only act if it's a good deal for you. An obligation, on the other hand, means you're on the hook. You have to follow through, whether you're making money or losing it. So when you buy an option, what you're really buying is choice. The person who sold it to you, they're the ones who accepted the obligation.
So now that we've got that fundamental idea down, that whole right versus obligation thing, let's get into the two main flavors of options. It's pretty straightforward, because a stock can really only go in two directions, right? Up or down. And yep, there's an option for each. They're called calls and puts. It's super easy to remember. If you think a stock's price is going to rise, you're bullish, like a bull's horns thrusting upwards. In that case, you'd be interested in call options. But if you think the price is going to fall, you're bearish. Picture a bear's paw swiping downwards. And for that, you'd look at put options. See? Calls for a climb, puts for a plunge.
So let's just lay it all out nice and simple. You're bullish, you think the price is going up, that's a call option, and it gives you the right to buy. You're bearish, you think the price is heading down, that's a put option, which gives you the right to sell. Your view of the market dictates which tool you use.
All right, so we know what they are. Now for the really big question. How do you actually make or lose money with these things? To get that, we need to understand just three more critical terms: the strike price, the premium, and what the profit and loss can look like. First up, the strike price. This is so important. It's the price that's locked into your contract. It's the price you have the right to buy at if you have a call, or sell at if you have a put. And it doesn't change, no matter how wild the stock's price gets on the open market.
So, what does it cost to get this powerful right? Well, that's called the premium. It's the price of the option contract itself. Think of it like that house deposit again, or maybe just the ticket price to get into the game. And here is the absolute best part for an option buyer. That premium is the most you can possibly lose, period.
And this is exactly what makes buying options so appealing to so many investors. When you buy a call option, your risk, your absolute maximum loss, is just the premium you paid. That's it, it's capped. But your potential reward? Well, how high can a stock price go? In theory, it's unlimited. It's this lopsided risk versus reward that's so unique.
Here's another way to see it visually. This is a payoff chart for buying a call. See that flat line at the bottom? That's your loss. It can't go any lower than the premium you paid. It hits a floor. But now look at that line shooting up and to the right. As the stock's price climbs higher, your potential profits just keep on growing. Capped risk, uncapped reward.
And don't worry, this awesome feature isn't just for the bulls. The exact same principle of limited risk applies when you buy a put. You're betting on the price to fall, and if it does, you make money. But if you're wrong and the price goes up instead, well, look at the chart. Once again, your loss is capped right there at the premium you paid. You know your maximum downside before you even click buy.
Okay, we've gone through a lot of the what and why, so let's wrap this up with something you can actually use. 3 essential rules that every single beginner should keep in mind. Getting these down can help you avoid some of the most common rookie mistakes. Rule number 1, and I know I've said it before, but it's that crucial. When you buy an option, your loss is limited. The most you can ever lose is that premium. That's your total risk. Rule number 2, these things have a shelf life. Every option has an expiration date, and its value literally melts away a little bit each day. It's a concept called time decay, and it's always working against the option buyer. And finally, rule number 3, please avoid the temptation of the lottery tickets. You'll see these super cheap options that seem too good to be true, and guess what? They are. They're cheap for a reason. The odds of them paying off are incredibly low.
So there you have it. You've got the fundamentals down. You know about calls for going up, puts for going down, and most importantly, you understand that amazing principle of limited, defined risk. So it really just leaves one question, doesn't it? As you look at the market right now, are you a bull or are you a bear?